Welcome, everybody, to our session this afternoon on impact investing, turning mainstream what drives real returns. So, the private market for impact investing has grown as much as $2.1 trillion last year, at least according to IFC estimates. In 2019 alone, private capital firms raised more than $76 billion in funds with an impact mandate, and still more are to come. Canada's Brookfield Asset Management is in the market to raise as much as $12.5 billion for its new impact investment fund. However, according to the IFC again, only a quarter of the market is clearly measured for financial and development impact. So to discuss this today with us, impact investing in private equity, we have three seasoned investors. Saima Rehman, Investment Officer at the Development Financial Institution IFC. We have Fernanda, partner at global impact investor LeapFrog Investments, which has raised more than $2 billion across 4 private equity funds. And Ming, Managing Director at ABC World Asia, which in 2019 raised some $285 million for its debut fund, targeting businesses in China, Southeast Asia, and South Asia. So welcome to our panelists. So to start off, perhaps we could start by, defining what impact investing is from a private equity perspective. Perhaps Fernanda, if you want to take this question first.
Sure, I'm happy to. Yeah, so there is, I guess the best way to define impact investment is look at investing in general in 3 categories. One is investment as usual, and where an investment can have a potential negative externality, right, into the environment or society. That's a traditional investment, doesn't take into consideration the impact and the consequences of the investment. There's a second category, which is ESG. So it's kind of the baseline, do no harm, and not causing any negative impact, and doing no harm. And impact is one step ahead. So it's actually, you are investing with an intention to cause a positive social or environmental impact via your investment.
Right. Shao, did you have something to add on this?
Sure. I think over at ABC World Asia, we look at impact investing as contributing towards a solution. As we look at the problems that the world is facing, ranging from the climate crisis to the unequal access to opportunities, be it in healthcare, education, or financial services. I think the United Nations has defined the 17 UN SDGs as aspirational goals. And as impact investors, we want to direct capital to contribute towards solving some of these problems by addressing at least one of the 17 SDGs when we make investments. Yeah, so that's our approach here at ABC World Asia.
Right. What about from the LP approach, Saima?
Thanks, Michelle. I wouldn't say impact investing is different from a different investor approach. So I don't think LPs have one approach, or GPs have one approach, or bankers have one approach. I think impact investing, as Fernanda outlined earlier, is very clear. The definition is that it must be intentional and it must be measured. So I think once you have that down, that in its truest essence is impact investing. And what impact investing differs from ESG, for example, in the sense that impact investing focuses on the externalities. It looks at the final outcome of your investment activity. And it's not to be confused with ESG in the sense that you can have an ESG positive company that still has a negative impact. An example of this is, let's say, a tobacco company that is doing very well on greenhouse gas emissions or diversity and inclusion in its own workforce, but is essentially producing a primarily negative output, tobacco. So impact investing is something that produces positive, intentional impact and is measured.
Right. But maybe we could understand how impact investing, as it is taking place today, different, I guess, how it's evolved over the past few years. Fernanda, maybe do you have some data to share, perhaps?
Yeah, I mean, it's interesting. I think we see this change in three ways, and if we can divide in terms of supply of capital, the managers in the middle, right, and the demand for impact dollars. And Michelle, you mentioned the growth of the supply of capital for impact investment, right, including Asia. So you see, you mentioned a couple of numbers. Jean measures it's the Global Impact Investment Network, IFC, to over $1 trillion, right, in the impact industry. And what we see is that this supply of capital will continue to grow. Young investors are allocating much more capital behind impact. We have anecdotal evidence in our LPs, including Asian families. And Bank of America runs a survey called Insights in Wealth and Worth. And they report that American millennials are allocating around a third of their capital, which is 50% more than the Generation X. And a majority of these millennials are willing to increase portfolio in impact. Plus, there's no doubt that global concern around climate change increased, right? It is top concern in voters in Europe now. It takes up consumer concerns, and you see this across consumer surveys across the globe, including here in Asia. So the supply of dollars backing impact in the last years increased, as you said, and will continue to grow, right? We have these leading indicators. And then in the middle, I mean, we see an increase in the number of impact managers investing for market returns. So Jean also last year estimated that around 2/3 of 1,700 managers or organizations that manage impact capital actually invest for market returns. So these managers are looking at backing scalable commercial businesses, right? That should have a large impact also. And when Andy Cooper launched LeapFrog 14 years ago with the mission of profit with purpose, he was expecting 1,000 LeapFrogs to come, and indeed they are here. But many are not impact only, right? They operate sometimes with two brands. There is some LP concern in lack of authenticity, or that they might be, perhaps just simply relabeling views as impact. So more managers, but some also concerns around authenticity, and the industry has responded, and with more impact measurement, as Saima said, and then IFC Saima here has driven the creation of key standards, right? So this is in the middle of managers. And the third is the demand, and the demand side for impact capital has increased, right, to address the sustainable development goals. I think the World Bank estimates that we need 5 to 7 trillion a year of financing. And with COVID, some have not only lost families, members or friends, but actually we see that 2/3 of families in emerging Asia have saw a decrease in income. And in the last two decades, poverty was reduced, right? But with COVID, 100 million people went back into poverty. World Data Labs measure this carefully. So, for us, I mean, LeapFrog, the way we deliver profit with purpose is by serving and giving essential financial and healthcare tools to emerging consumers. There are 2 billion emerging consumers in the world, probably more now after COVID, in our key markets. And the purchasing power also of these emerging consumers, for us, the 2 billion in our key markets, Africa and Asia, is over $10 trillion, right? So it is the demand for impact investments, impact dollars also is increasing. The need and the capital required to address SDGs is very large and increased after COVID.
Right. But Saima, from your perspective, though, how have you seen, the industry evolve over, I guess, more than a decade with the IFC?
Sure. This is an interesting one for me because IFC has always been an impact investor. We never called ourselves impact investors. because we're a multilateral agency, we're a development finance institute. Our mandate is a double bottom line when we invest. Our shareholders are countries, so we're supposed to be, we're obliged to make investments that have a positive impact, whether it's creation of jobs or whether it's addressing gender imbalance, whether it's climate change related. So from the IFC internal point of view, we're doing what we've always been doing, meaning we have an intentional impact scope when we make our investments. We measure those investments across the life of the investment. We publish those results, and those results are audited. What we have seen in the last, let's say, 10 years, as you asked, is we've seen a lot of talk about ESG, and more recently, we've seen a lot of talk about impact. In the beginning, this was a lot of, jumping on the trend and, riding that wave and following, a new pool of money. However, I think it's fair to say that this has become a lot more serious. Investors have become a lot more educated about the space. We see a lot more debate and dialogue about greenwashing and impact washing, for example. So people are now cognizant of what is real and what isn't. And I think there is a bona fide effort on the part of GPs and LPs alike to work together and create a framework that works. So we're seeing that very positive trend develop over the last 10 years. And certainly after COVID, we're seeing a lot more.
Right. Just to follow up there very quickly, so you said that interest is picking up, but just wondering to what extent is it driven by LP interest or demand?
Well, I mean, not to be cynical, but the reality is that money talks, right? And GPs tend to follow where LPs say they want their money directed at. So that's I would say the first thing. The second thing is consumers talk, right? That's another part of money. So a lot of companies are seeing that their customers' behaviors are changing. So a customer would rather buy from, let's say, company B and shift away from company A due to sustainability factors. It could be anything from child labor or sustainable supply chains. So where your customer is voting with their money in terms of where they're shifting their choices in purchasing, that speaks volumes as well. And then the third part, which we're seeing, a real bona fide effort and a lot of PE managers as well, putting a lot of money here and effort here, is that I think there's a new class of entrepreneurs that is putting sustainability at the heart of their business strategy. These entrepreneurs are, looking at global megatrends, and they're trying to solve, our most pressing problems today. And, when you're trying to solve a problem, you're trying to solve an unmet demand. And that is always an incredible space. And, early movers always have the best advantage. And, to give PE its credit, private equity has always been, the backers of, global megatrends. It's always been behind that unmet demand, whether it's, the circular economy or, the transition from in energy. So I think, money is speaking from both ends, but in the middle, you have a group of business people, entrepreneurs, as well as investors who are keenly interested in solving problems and getting ahead of the curve.
Right. Shao, Ming, maybe we can pick it up from here. I mean, so based on what Saima has said, how does impact investing fit in with private equity strategies? Given that private equity is known to be hard-nosed, driven to achieve robust returns, and typical strategies are buyouts or controlled stakes.
Right, thanks. I generally agree with what Saima and Fernanda has said. I think private equity is known to be hard-nosed and also objective-driven. However, that can be seen as a strength when it comes to impact investing, because we need the same pragmatism the same level of rigor and discipline in driving companies to meet the impact goals. So from a risk management and investment perspective, companies with strong impact intentionality and also measurable outcomes are generally more resilient, they are more sustainable, and they can deliver healthy financial returns in the longer term. Hence, I do see that private equity can actually play a very instrumental role in driving change and bringing about and contributing towards solving some of these problems that the world is facing right now.
Are there particular PE strategies, though, that translate well to impact investing?
Sure. I think in today's world, I think impact investing is still fairly nascent. There are a whole range of managers out there trying various PE strategies. For example, for us at ABC World Asia, we play in the growth capital and mid-stage VC space. There are impact investors. For example, IFC is active in not just the private equity space, but also the private credit space. We've also seen other managers adopt buyout strategies in the impact investing space. So as the industry matures, I expect to see more and more varied strategies with the same intentionality and the same rigor to pursue impact. And hopefully we'll see that in the next few years.
Right. But just to understand also, how are the investment processes different from traditional private equity investments, if at all? How does one assess suitable targets for impact investments? Are there specific metrics that one uses?
Sure. I think if you look across the industry today, there isn't a set of standardized matrices that can be applied across all types of impact investments. I think it also speaks to the varied problems that impact investors are trying to back and solve. So for example, trying to measure something with environmental impact is going to be very different from measuring the performance of an investment that is targeting to solve a social problem. And hence, I think this impact measurement is going to continue to evolve over time. But at the same time, I think at the back end, I think what all impact investors are focused on is really the intentionality and being able to hold companies to matrices and measurement that can be tracked over time and to hold companies accountable for that. So I think that is very important for us as impact investors when we pursue these different investment opportunities.
Right. Fernanda, how is it like at LeapFrog in terms of, when you assess targets?
Yes, no. As you said here, we have a very clear kind of intention, right? And we understand our additionality when we make an investment. So the way we measure our mission and our mission, profit with purpose. So profit is easy to measure, right? It's money multiple IRR, very easy to measure. And we measure impact, the purpose, in mainly like two dimensions, I would say, if we can simplify and put them in two buckets. But one is reach, right? So the whole theory of change at LeapFrog is that an emerging consumer, if she or he loses her job or because of health, death, or just loses a job, it's much more vulnerable and has a chance of going back into poverty. So the investment thesis is really to provide these essential financial tools in healthcare to these emerging consumers at scale. And with that, have a very clear kind of outcome of the delivery of these products. So the first one is reach, right? So we measure the number of low-income consumers, so the emerging consumers, and we use the World Bank definition of $10 a day per capita in the family, and the number of women and so on. So it's the reach of the product of our portfolio companies. And then there is a second dimension, which is more related to the product and the affordability of the product, like what is the cost of the product compared to benchmarks, and the product quality. So if it's an insurance claim ratios is very important, right? So we measure repeat rates, claim ratios, NPS, a number of complaints received. So there's a whole set of measures for us to allocate to products. And fund managers, I mean, typically, and it's, each one measuring a different way. I mean, you can measure at a fund-wide level, right? Large, like, for example, the reach that I mentioned, or you can also measure on a deal-by-deal basis, and we do both, right? So we measure the deal-by-deal basis, so create frameworks for different business models that will measure this component of affordability and the quality of each product.
Right. So you've also mentioned greenwashing earlier, maybe Shao Ming also. How do you sort of pick the genuine businesses, and how do you hold the businesses or the founders to their intention?
All right, maybe I'll start. I think over at ABC World Asia, we have designed an investment assessment framework where at the first stage, we assess the intentionality of the entrepreneurs and also to assess the business model to see whether that fits into the overall impact investment mandate. And that's designed to quickly eliminate deals that are not in the impact, in the impact mandate. And then the second stage of it, where we, after doing more detailed work and due diligence on the company, we then assess the company's impact potential across multiple dimensions, including like what Fernanda has mentioned earlier, the potential reach of the company, the depth of the impact, the contribution of the company, as well as the risk that comes with the impact. And in this entire process, we also look at the ESG performance of a company. And hence, by adopting a more structured investment process, we try to eliminate deals that are not meeting our impact hurdle. But at the crux of this, I think the intentionality, as what Fernanda mentioned earlier, is very important, because we can only design whatever matrices from the external. But if the entrepreneurs have this intention to pursue impact, that helps us to align in terms of working with them on the post-investment work as well. So that is very critical to us.
Right. You mentioned risk, Shao Ming. So, I mean, what is the risk to impact investing? I mean, is there a downside?
Oh, yes. I think in terms of risk, I would say there is a big overlap in terms of the impact risk with the financial risk. For example, if we invest in a chain of clinics, we have to look at the competition. We have to look at the pricing, the price points. We have to look at the go-to-market strategy and understand whether this business has the ability to reach out to the number of customers that it intended to do when we did the underwriting. So there will be the business risk, there will be the competition risk. There's also the impact risk. And I think this is maybe what drives the difference between just a financial investment and the impact is we try to understand whether the founders are grounded towards this impact goals and dedicated to the cause, or they will, otherwise there might be a risk of a drift when the business grows.
Right. Fernanda, what is the downside, do you think? The
downside in what sense?
Is there a downside to impact investing? What's the risk that you think is in it?
Yeah, no, I mean, similarly to Shao Ming, I mean, we don't see a downside, right? We just see a combination. So we want to combine both profit with purpose. So we are not giving up on commercial returns for the impact we are causing. And for us, we design our investment thesis and have been deploying it on the back of it for 14 years, right? And it's a very intuitive thesis. It's very straightforward, and returns are mainly driven in two ways, right? All of us know that in the next 10 years, billions of new consumers are rising in emerging markets. And for us, it's health and wealth, as I mentioned. And these are the things that they want first, right? When they become consumers, especially post-COVID. So financial tools like loans, productive loans, insurance, remittance, and healthcare will be heavily consumed in emerging markets. And this demand will drive growth of company providing such products at scale. And the investors who get behind these companies, our LPs, ourselves, should do especially well, right? So the trick in this investment thesis is that these companies have to innovate in a few dimensions, and mainly because of two things. One, because emerging consumers are using these things like insurance and pensions and borrowing formally for the first time. So products need to be simpler, easier to understand, like Facebook, WhatsApp, like consumer experience, and yet high quality, right? Otherwise, they will never buy it again. And second, emerging consumers don't have a lot of money, so even less now with COVID, as we spoke before. So these products need to be such a size, distribution needs to be inexpensive. So there's a lot of execution related to it. So you know, we ended up driving returns and not compromising on returns in two ways, right? Meeting the demand of these emerging consumers in high growth markets, so fulfilling our purpose, but also the second drive for returns is actually finding those companies that can innovate at the product and distribution level, right? So the unit of economics of serving these emerging consumers actually works, right? Can be attractive and provide the returns that shareholders expect.
All right.
Right.
I think
So,
looking.
as you've
Sorry, just looking at the risk of investing, right? I will also want to point out that there is a risk of inaction. And I think if you look at the world today, there's increasing consequences, including rewards and penalties for acting or for inaction, right? Take the example of climate change. I think in the recent IPCC report that was published, it says that we have to halve our carbon emissions by half by 2030 and to be net zero by 2050, just to limit global warming to 1.5 degrees Celsius so that we can all avoid the worst effects of global warming. And last year, if you look at last year, a Dutch lawyer actually took up a case against the oil giant Shell. The main arguments of his case was that, number one, there was clear evidence that warming beyond 1.5 degrees Celsius will have dire consequences for the planet, and that any company that ignores it is doing it consciously. That's the first point of his argument. The second point of his argument is that companies have a clear duty of care to ensure a healthy environment for the world's citizens. And the court actually ruled in his favor that Shell has to cut its greenhouse gas emissions by 45% by 2030 compared to the 2019 levels. So we'll see more penalties such as emissions-based taxes, quotas, and on the other hand, we have companies that are generating carbon credits, new sources of revenues which are unheard of previously. And this is a reward for contributing towards a cool earth. And many companies and many countries have signed up to the net zero commitments. And also in China recently, they've introduced this idea of a common prosperity, which is just to level the playing field and provide equal access or more equal access to segments of the population. So echoing what Fernanda has said just now, I think the younger generation today have increased expectations on the brands and the companies that they support.
Say it's limited or limiting. And the other thing is, you know, given that you're investors in emerging markets in particular, you know, how do you sort of balance the risk and return in this area? Maybe Fernanda, you can take this first.
Yeah. So the risk of the emerging markets, and we only invest in emerging markets, right? And when you look at emerging markets, what it provides to us, I mean, apart from obviously, you know, where the people we want to reach are, but these are also high growth markets, right? We're talking about growth rates above 5% across our markets. So you're selecting high growth markets, selecting industry that grow at least like 2 times the GDP of those countries. And then within those industries, healthcare and financial services in our case, we are cherry picking the companies that are focusing on a large latent demand, right, for services, the emerging consumers that haven't been served or it's been badly served these days. So typically our companies will grow above 25% on average. They have been doing that a year. So it's growth on top of growth on top of growth. So yes, I mean, emerging markets could provide in one single country, maybe perhaps higher risk relative to developed markets, but we are investing in a number of companies in a number of markets and having that diversification that then helps out balance the risk, right? Diversification, but also this high growth scenario where our portfolio companies operate. And we are not seeing less opportunities, right? I mean, there's tremendous opportunities. I mean, we need 5 trillion a year to solve SDGs. Obviously, it's difficult to solve all at once, and we have to pick and really be thoughtful about where and how we can deploy our investment thesis. But you know, there's tremendous potential, right? And a lot of opportunities. The pipeline at LeapFrog is very deep and heavy, so I don't think there is any lack of opportunities for investment.
Yeah. Shao?
Right. I echo Fernanda's point. I think right now the opportunity set is much bigger than what managers can invest in today. There are a lot more opportunities than managers. I think mathematically, if you think about impact investing, you are putting on additional constraints on your portfolio compared to an unconstrained traditional private equity portfolio. So theoretically, there will be a smaller opportunity set. But at the same time, this opportunity set is large enough for all of us here to be investing in and still make healthy returns, both financially and also to deliver the impact. And also just to add on, adding on to the trends that I mentioned earlier, there's this whole new generation of entrepreneurs out there who are coming up with innovative solutions and technology that addresses, say, healthcare or education or financial access in different markets, and also things like climate change. So as the market realizes that, you know, there is a need to address these problems, they will also come up with additional solutions, and all these solutions will need funding. So as an impact investor, I'm not worried that there will be a lack of opportunities. In fact, we are swarmed with opportunities right now. And just adding on to your second question, which is on the emerging markets risk question, I think we are no different from a traditional private equity. We are headquartered in Singapore. We are anchored in Asia. And we understand that Asia is a relatively complex operating environment. Every country has its nuances, its own culture, and its own regulatory structure. So for us, we are familiar with Asia geographically, and we will adopt the same rigor and also the same flexibility when we look at opportunities in each of these markets, because we cannot expect to apply a cookie cutter approach towards all the different Asian countries. Yeah.
Right. Shao, you mentioned constraints. I'm just wondering, as managers of impact funds, you know, what are some of the more pertinent issues that you face that perhaps, I guess, more traditional private equity fund managers do not face?
All right. I would say that the first major difference is the impact lens, because we are really looking for companies where the core business, the products and the services addresses a problem and contributes towards a solution. There are companies out there that do not address the provide that solution, although they are making good money in the market, and that immediately is eliminated when we look at, you know, when we look to invest in these companies. So I think that will be the first major constraint. And then we also apply different other screens, for example, ESG performance, and also the intentionality to further refine the subset of companies that we want to invest in.
Right. Fernanda, perhaps?
Yeah, no, just to complement, we do have constraints, and the main one is related to our purpose, our impact, and the ESG filters that we will apply also. So, and for us, I mean, there's plenty of companies serving emerging consumers, right, with products, but either they are not high quality or meaningful products for these emerging consumers. If you have a loan, it's a digital loan, easy to get, perfect user experience, but it's charging you 200%, 300%, 400% interest rate, and for you to buy new clothes necessarily not for productive means, potentially this could be outside our scope, because we don't see the high quality and how meaningful it is for the emerging consumer. So not deploying responsibly high quality products with the right credit analysis of a client, so to make sure it's not being over indebted, for example, or if you're creating an insurance product that at the end of the day nobody uses and there's no claims paid, this is not a high quality product. So for us, we see a number of companies serving emerging consumers. So in theory, it could be right at our sweet spots. But when you double click on the company, on the values of the company, on the values of the entrepreneur that was brought up here a few times already, and the quality of the products, it just doesn't meet the standards that we expect.
Right. Sounds like a lot more sort of intense due diligence, as it were. Saima, I wanted to ask you about something that Shao Ming said earlier, in sense that, he's saying that there was a lot more opportunities, than investors, I guess, than managers currently in impact investing. And just from the IFC point of view, what goes on? I mean, what do you look at when it comes to manager selection for this particular mandate?
Yeah, thanks. First of all, let me apologize. My laptop crashed twice. So I restarted and crashed again, and I'm on a completely new laptop now. Look, I'm sure I missed quite a lot of interesting points, but in terms of manager selection, I think IFC is very clear, and we have been, that if a GP is not interested in ESG at a minimum, I'm not talking about impact here, I'm just talking about ESG at a minimum, and we're not interested in working with that GP. I think, that differentiates a certain class of GP from another. In terms of, what our expectations are, we expect that at a minimum, GPs will implement and reinforce ESG standards wherever possible. On top of that, what we have found over decades of investing and working with good GPs is that the best GPs use ESG positively as a lever for value creation, right? If you are driving value in your portfolio, you can use E, S, and G to drive that value, drive sustainability, and achieve impact. So that's where, ESG and impact can merge successfully. And I think that's a very clear selection criteria for us. That as a minimum, we're only interested in working with GPs that are committed to managing environmental, social, and governance risks. And we see it even more positively if they use those underlying risk management tools and use those to address opportunities, right? ESG opportunities to create positive impact. And once you meet a lot of GPs, you can fairly quickly understand which ones are serious about it and which ones aren't.
Right. I want to take the last few minutes to look at, how the industry will continue to develop. Perhaps, for example, what does one make of the criticism that there has yet to be definitive measurements, for impact investments, and sort of the implications of this? How are we progressing in that sense? Maybe Saima, you wanted to continue with this first?
Sure. I think, as Shao Ming mentioned earlier in one of his responses, the measurement metrics of impact investing are not set in stone. They're still evolving, and it will really depend on your own investment strategy. So if you are a climate investor, your metrics will be different. If you're a base of pyramid investor, or a financial inclusion investor, your metrics will be different. I think the one thing that we can standardize, and we are standardizing, is your approach to investing, right? IFC has co-authored with a number of others the operating principles for impact management. You can go to the website, you can Google it, it's available for everyone. We have, I think, 140 signatories, but only about 400, I'm sure I'm getting this number wrong, only around 4.2 billion in AUM signed, which is, it's a fraction of the private equity money out there. But it's growing. And these principles basically say that, look, good investors bring reputational risk and governance, whether it's a board seat, whether it's accounting standards, whether it's auditing, they bring that into the heart of their due diligence, their portfolio management, and their investment strategy. Same way you can bring impact. So you start with the intention, you build that into your strategy, you build your metrics out. There are 9 principles, and it goes all the way from the beginning right to the end, where you publish, you tell people, these are the results that I've had. You have independent verification of those results. And, firms that are willing and able to do that are the ones who will be the winners. And you'll see the big ticket names in PE, whether it's KKR, TPG, BlackRock, they're all jumping on this bandwagon. They're all, signatories to this, to these principles. So I think, that's a good starting point, and it will evolve from there.
Right. Fernanda?
No, I just would fully agree. I mean, there is definitely, it's a fair concern. I wouldn't say concern, but it's a good attention point. But the industry is responding and evolving, right? And then a lot of capital backing it and wanting to have these metrics and the transparency that is required. And look, I mean, it's very easy to measure profit and returns, right? It's only one metric, is money coming in, but there are 17 SDGs. So, the challenge remains, right? To measure those 17 and companies against those. And it's just a natural problem, right, within that. But I think the intention and the capital behind it and the young generation fully supporting it, as we said here, right? Not only global concerns around climate change, but already a much larger allocation to impact is just, it's just a process, and we're gonna improve as we go along. And it's already much better. I mean, we also supported and launched with the IFC with the operating principles, and it's a game changer, right? It talks about the strategic intent. It talks about the managerial additionality, the measure, the third-party verification, right? So all of this is crucial, and it's great to see more managers adopting it.
Right. Well, I'm afraid that's all the time we have for this particular session. I really want to thank all our panelists for your insights and for really sharing what seems to be a very challenging sector, as it were. Thank you again, and have a good afternoon.
Thank you.
Thank you.